talk about mortgage. Most importantly, let's talk about the value that your house accumulates over time. This class is mostly for people who own houses and also for people who don't have one right now, but in the future they are thinking about buying houses or just one home. Either way, when you buy a house, when you own a house, your house accumulates some value. That value is called equity. That equity, you can leave it in your house. And when you sell, you will have more money in your pocket. Or if you have some financial issues or some repair that you want to get done, or some bills that are coming overdue, you can borrow against your house. You can borrow against the equity. There are several financial tools to do that. But let's focus on one of them that all of us know is refinancing. We also will focus on home equity loan. And lastly, we'll be talking about home equity line of credit, ELAC. What are they? They are all financial tools that if you use them wisely, you will be able to prepare your retirement. Let's go in detail to talk about each one of them, and you will see which one is more effective for you. The first one is refinancing. Refinancing is one of the tools that you can use to refinance, to replace your existing mortgage. You replace your mortgage with a different loan with different rates and different terms. Let's say that you have your house and you have some issues and you say, you know what, I'm going to refinance because when you purchase, it was 7%, now is 4%. You want to take advantage of that. You say you will call your bank to say, I want to refinance. And you don't have to refinance with the bank that already lends you money. You can go to a different bank. When you do that, they will ask you for the same thing. Again, you're gonna apply, and if you get approved for that percentage, you will have a different term, different rate, and you will also have a different amount. You will apply to replace whatever you already have. You can refinance, or homeowners may refinance to obtain lower interest. That's the main reason you should refinance your house. And also, you can do a refinancing to cash out whatever you have, and you can use the excess for fun. That's why when we talk about equity, as I said before, we have two types of loans that are related to your equity. Let's take the first one is home equity. Home equity is when you have a house and you want to take money, you want to apply for a loan. That loan will be tied to your house, to your equity, so you can take care of some businesses, if any, buy a new one or do some repair. So the equity, what is that? The equity is the difference between the appraised value, difference between what your house is worth and what you still owe on your house, what we call outstanding balance. So let's say, how does it work? Let's say first that with a home equity loan, you will have to, even though you borrow against your house, you will have to repay that loan and fix installment and a specific period and a fixed interest rate. Let me give you an example so you can understand better. We're gonna use a simple scenario of Jen who has a house. Her house or his house is worth or is being appraised and is worth $200,000. That's what the house is worth. So now to find the equity, you will have to know how much Jen still owes under the house. Let's say that she already pay 80,000 or 80,000. So she still owes $120,000 on that house. The equity will be the 80,000. To make it easier for you, the house is worth 200,000. She still owes 120,000. The difference will be the equity. The equity will be $80,000. Meaning, if she sells today, she will be able to take home 80K. But one thing about equity is that only you can borrow against your equity. Some banks or some states will allow you to borrow up to 80% of the house value. Meaning, the house is worth 200,000, you can borrow up to about 160,000. You don't have to borrow the entire equity. You can let's say that you decide to borrow 100. You pay some bills, you buy a new car, but remember, you borrow that money with an interest. So you will have to pay that money back. If you only borrow $100,000, you will be paying back your actual, the different loan. You will be paying the actual, the original mortgage and the second mortgage. So practically, when you do home equity loan, you practically put a second mortgage on your house and you have to pay it back. There is a loan once. Later, we'll be talking about it. This example I just used was for home equity loan, which sometimes they call HEL. Now, let's take another example. Rather, let's talk about HELAC. HELAC is home equity line of credit. For you to understand HELAC, let's use one simple term of reference, credit card. If you know how credit card works, it's easy for you to understand how HELAC works. Let's talk about that. HELAC is home equity line of credit, is a revolving credit, is a revolving loan, meaning that you can, when you start paying it off, your balance increase like a credit card. Is a draw period. When you do home equity loan, the bank can tell you no, you can pay it off in 20-25 years. When you do HELAC, the draw period is between 5 to 10 years. So what is it? Let's explain it more so you can understand. Once again, as the refinance, as the home equity loan, HELAC also have interest rate. There is a repayment plan, but you will see the difference later. So also same as HELAC, you can borrow up to 80% of the appraised value of your home. The reason many people do HELAC is because it's more flexible. You only repay what you borrow. When you do home equity loan, you ask the bank for 100,000. That's what they give you, and you do whatever you want with it. Whether you use everything or you don't, you will have to pay it back because you borrow that much money. But with HELAC, is more flexible payment. Your payment can be $2 today and 5 tomorrow, or 50 cents the next day. Is because you only repay whatever you borrow. Let's take a quick, simple scenario so you can understand better. On your mind right now, think ELAC as credit card. Think ELAC as credit card. The same way you pay your debit card, this is the same way you will pay off your ELAC. Let's take an example. Still, Jane has a house. The house is appraised, let's say, same amount, $200,000, and she still owes 120, and she has the equity now will be 80. Same example, 80 is the equity that she has on the house. The equity is the difference between the appraised value, what your house is worth, and what you owe on your house or what you already pay on your house. So now let's see. Now, a Jane wants to borrow some money to do some repair on her house. So the bank will tell her you can borrow up to 80%, which is $160,000. You can borrow up to that. But I don't want, Jane said, no, I don't want to borrow all that. The bank will ask her, do you want to do a home equity loan or you want to do ELAC? She's you know what, I'm gonna do ELAC because even though I know I will need 100,000, but I don't want it at once. So she said, okay, I will borrow, you can open my credit to 1,000. Jane will not get that much money. She don't have to take everything. So she's approved for 100,000, with interest rate and between 5 and 10 years for her to fix. Also is a second mortgage that she takes on the house. $100,000. She said, you know what? I am February 1st. I only want to borrow 20,000. She will borrow $20,000. She will take out of that 20,000 that she's qualified for. She will take 20K. When she is going to pay that money, she will only pay interest. She will only repay 20K. She's not going to repay $100,000. As opposed to the first time, when she borrowed 100,000, the interest was on that much. This one is for the home equity loan. But with the ELAC, sure, she's approved for $100,000, but she only take out 20,000. She will pay back 20,000. She will start paying down on $20,000. Let's say that she's authorized. That will be like as a credit limit. That's her limit. Now she's a line of credit that she has. And now she borrowed 20,000. 20,000 now is the balance that she owes to the bank. Let's say that her monthly bill is $1,000. This is like for like the home equivalent credit, not for the entire mortgage. So if the mortgage was 500, so she will have to pay 500 plus the 1,000. So let's say that February, March, April, May, June, let's say June, 5 months from now, she paid 5,000. She still have 100,000. But the limit now will go down. She cannot borrow she cannot borrow more than 20. Now the limit now will be the 80,000 because the limit will be going down whenever she take money out of it. Now is 20. Now is 80,000. She took 20 and now she end up paying, let's say 5 months, $5,000. Guess how much now she can borrow up to? She can borrow up to 85,000 because the credit is revolved. She paid 5,000, so her debt is only now $15,000. That's the beauty of HELOC as opposed to HEL, home equity loan, because you will only pay down as you go. You only pay what you borrow or what you spend, same as your credit card. So the good thing about HELOC is your credit balance increase as you make more payments. As example, she borrows 5,000, 20,000, she pay off 5, so now her credit limit she is still 1,000, but she can only she increase the 80 by 5, 85, so she can keep borrowing and keep paying back, keep borrowing, keep paying back as long as she don't go over 100. You can do that between 5 to 10 years. So, what are the key differences between refinancing, home equity loan, and home line of credit? The difference sits on the type, on the loan type. The type is different. So let's say what I can say: home equity loan and HELOC, L and HELOC, they are second mortgage. You will keep paying both. So if the original one was 400 and your HELOC or your AL is 1,000, every month you will be paying 1,500. That's the bottom line. As opposed to refinancing, the financing you wipe out the first one and you pay only on the second one because you replace your current mortgage with a new one. They are not second mortgages when you do refinancing. The second difference is payment structure. How does it work for all three of them? The home equity loan have fixed monthly payment. Fixed payment. This thing is for the home equity loan. Loan is a fixed payment. As opposed to HELOC, HELOC the payment could change. They got variable payment with the HELOC. Those are the difference in terms of payment structure. Also, the third key difference will be access to funds. How does it work? Home equity loan. Let's put that for you. Home equity loan provide a lump sum. Whatever you want, they give it to you and you pay monthly a per interest rate. As opposed to HELOC, they offer you a line of credit. You can decide how much you want to take out and you will only be paying what you borrow, and as you are paying down, your credit limit will increase. And also, let's talk about for interest rate. The interest rate is also key difference for those three. Home equity loans have fixed interest rate. Hell, fixed payment and fixed interest rate for the home equity loan. But a HELOC, the interest rate can vary. It depends on how much money that you have to pay. And also you can pay the minimum payment or you can pay as much as you can. When it comes to refinance, is also a fixed rate depending on the contract that you sign. Each option, they got the pros or the cons. The right choice that you will be making will depend on your financial goals. What do you want to accomplish? What are your needs? And also, what is your risk tolerance? If you want to do either one of them, refinancing, you want to refinance, or you want to have a home equity loan or a home line of equity line of credit, it will depend on you. You have to consider the interest rate. You have to consider the options, and you have also to consider the fee that are essentials before you make your decision. But if you still have doubt on how to do that, I'm suggesting that you consult a financial advisor or your broker. Your broker will be able to tell you what is the best situation for your situation. What is the best way, the best tool that you can use to make sure that you got the right one. Your broker will tell you what to do, but a financial advisor will be able to not only to see your house, but he will see your entire wealth, your paycheck, your debt, your hobbies together to make sure that you make the right decision. Nobody can tell you which one is right for you. When it comes to you spending your money or investing, nobody can tell you what is right. But if you want more help or if you want some advice, don't be scared. You can contact me or go to my website, apostrophe.management, or you can call me 618-823-8701. I will be able to guide you on the best way to do it. Once again, there is no best way, but a way that will be based on the options or your financial needs analysis. Thank you for watching Professor Rousseau Apostrophe Podcast class and session. And if you want, share this knowledge. Don't share the live, don't share the class, don't share the video. Share the knowledge with people you think may need some advice on the best way to use the equity on the house. Thank you. See you next week.